Hello everyone and welcome again to my How To Education channel. As I promised you on Wednesday, we will start with the finance content today, an introduction to corporate finance part 1. After watching this video, don't forget to leave me your feedback. So, what is corporate finance? Corporate finance is the branch of finance that tackles the funding of a corporation. That is, the actions that need to be taken in order to increase a firm's value, decrease its costs, and find the necessary capital for the firm's general functioning and for the short and long-term investments. These actions are what we call capital structure, capital budgeting, and working capital management. Let us define each of them. Any corporation has a variety of assets to manage. These include current assets and long-term assets. To pay for all of these, the firm probably got a lot of money, which came from either liability or from equity. A liability is a long or short-term debt that should be returned with interest after a certain period of time. The money from equity does not need to be returned, but instead, the creditor, which is the person lending you money, receives an ownership right over a certain percentage of the corporation. The decision between using liability, equity, or a mixture of both to pay for the assets is called the capital structure. Just as we said that a firm has a number of assets to manage, it also has a number of projects and long-term investments to take care of. The decision about which long-term investments to choose and the management of these investments is what we call capital budgeting. A good long-term investment is one which creates more value to the firm than costs. This means that the cash flowing into the firm must be greater than the cash going out. The capital needed to manage the firm's daily ongoing operations is the working capital. Some examples of working capital management decisions include whether or not to sell on credit, how and when to pay suppliers, and how much of inventory is needed. The net working capital is the difference between a firm's current assets and its current liabilities, CA minus CL. If the net working capital is positive, the current assets of the firm are sufficient to cover its current liabilities. Whereas if the net working capital is negative, the current assets of the firm are not sufficient to cover its current liabilities, which might lead to bankruptcy. After going over capital structure, capital budgeting, and working capital decisions, one might ask, who are the people that take these decisions? Are they the owners of the corporation? The answer is no. In a large corporation, the business decisions are not taken by its owners. The owners are the ones that previously gave money in the form of equity to pay for the assets. As a return, they get an ownership right over a certain percentage of the company. A potential problem here is that since equity is a very common source of funding, the corporation will end up with many owners and will not be able to manage if all of the owners decide to take decisions at the same time. This is why the owners appoint managers which will be in charge of the decision-making process. The capital structure, budgeting, and working capital decisions are taken by financial managers. The CFO, Chief Financial Officer, is the leader of all of the financial managers. Throughout the last couple of slides, I generalized the word corporation. So, let's just make this point clear. A corporation is not the only form of business firm or business organization. In addition to the corporation, There are also the sole proprietorship and the partnership, the latter being either general or limited. Let's define each of them now. As the name suggests, sole proprietorship is a business made of a single person. It is the most common form of business and the largest in number. This kind of business is like an extension of the owner, meaning that the only tax that the owner has to pay is the tax on personal income. There is no such thing as corporate income or taxation on corporate income. Since the sole proprietorship is only made of one person, in case of problems or debts, the owner takes the full responsibility, or, in other words, he or she has unlimited liability. In addition to that, since this business is an extension of the owner, there is no difference between the business assets and the personal assets, meaning that personal assets can be confiscated in case of death or bankruptcy. The money coming from equity will be much less in a sole proprietorship, since the business has only one owner. This amount will depend on how much money he or she is able to invest in the business. Of course, sole proprietorship has certain advantages. It has only one kind of tax, it is the easiest to start, the least regulated, and the owner is able to keep all the profit to himself or herself. Nonetheless, it has some disadvantages too, such as unlimited liability, limited amount of money from equity, the ownership duration is limited to the life of the owner, it is hard to transfer ownership of the business from one person to another, and so on. Another form of business is a partnership. A partnership is a business made up of two or more parties, and where all the profits and losses are shared between the partners. There are two types of partnership: general partnership and limited partnership. In a general partnership, all partners provide a certain amount of work plus money for the company. The profits and losses will be shared by all the partners, so if one of them isn't able to fulfill his or her work or money duties to the firm, the other partners must make up for his loss by providing the missing amount of money or work. This means that all general partners have unlimited liability for all the debts. In a limited partnership, in case of bankruptcy or any other arising issue, the limited partner is only liable to a certain extent, determined by the amount of cash or work invested. In other words, if partner number 1 does not fulfill his obligations, partner number 2 has no obligations at all with partner 1. This is called limited liability. The limited partner also does not participate in the management of the business. Just like the sole proprietorship, partnership has some advantages and some disadvantages. The advantages are: since there are two or more owners, more capital will be available. It will also be relatively easy to be started, since it's not as large as a corporation. And just as the sole proprietorship, the only taxable income is the personal income. Some disadvantages of the partnership are: partnerships have a limited life that will cease to exist when one of the partners dies or wants to sell his membership. It is also hard to sell or transfer ownership. Also, in the case of general partners, the liability is unlimited. Lastly, a corporation is the form of business where the owners are not the managers. In other words, the owners are not the ones making decisions. This brings many advantages, such as limited liability. The corporation will not stop if one owner leaves or dies, and the ownership is easily transferred to someone else. All of these advantages will be very helpful to the corporation when raising cash, which is much harder for the sole proprietorships and partnerships. The main disadvantage of the corporation is that both of its incomes are subject to taxes, which is what we call double taxation: the personal income taxes and the corporate income taxes. The personal income comes from something called dividend. Dividend is the returned money that the owners had previously invested as equity. If we were to compare corporation with partnership, the main characteristics of corporation that we would emphasize on are double taxation, limited liability, unlimited life, and freedom to decide when and how to pay dividends. But before we emphasize the characteristics of partnership, let us go over shares, stocks, and dividends. As mentioned before, the money received through equity does not need to be returned. That is, a person giving money to the company as equity will receive a number of shares of stock in return. The more money being invested, the more shares the person receives, and so the more ownership right he or she has. In addition to the shares, the company might also decide, but it's not obliged to give his money back to the owners in the form of dividends. Each share of a corporation gets the right to one vote. So an owner with 40 shares has double the voting rights of an owner with 20 shares. Owners are also called shareholders or stockholders. Shares can be easily exchanged, as in bought or sold, which means that a corporation has a high liquidity. For a partnership, taxes are only on personal income. General partners have unlimited liability, whereas limited partners benefit from unlimited liability. Limited life, shares cannot be easily bought or sold. General partners are usually the ones with voting rights, even though limited partners might have some voting rights too. And we don't usually talk about dividends. Instead, the profits received are distributed among the partners, who are usually forbidden from investing them again in the company. Even though in a corporation all of the workers must have common goals, as for example to sustain competitive advantage, each department also has a set of goals specific to that department only. The marketing division's main concern is certainly related to sales and brand image, and not to shareholders' wealth, for example. The financial management division is the one whose main concern is the shareholders' wealth. In other words, the financial management ensures that the value of the company's shares is the maximum that can be. Even though this division is very beneficial, it can also bring some problems. We will speak about one of these problems next week. This is it from finance for this week, which probably relieves you a lot. Anyway, if you have reached the end of this, it is because the content is helpful to you somehow. If this is the case, then please give your friends and acquaintances the opportunity to have access to these videos by liking, sharing, commenting, and subscribing to the channel. We will be continuing this chapter next Friday, but before then, I will see you all on the weekend with some tips for writing a motivation letter. Thank you so much.